Hello, and thank you for joining us. Over the next few minutes, we'd like to share our latest market outlook and discuss several themes we're watching closely as we move through the second half of the year. Today's presentation will cover three topics: inflation and the economic outlook under the new Federal Reserve, the emergence of artificial intelligence and how it compares with previous technology revolutions, and why portfolio rebalancing remains an important part of long-term investment management. As always, our goal isn't to predict short-term market movements, but rather to provide perspective on the economic environment and explain how we're positioning client portfolios through changing market conditions. The first 6 months of the year were very strong for equity markets, both in the United States and internationally. U.S. small-cap stocks gained more than 20%, while international markets also delivered solid returns of roughly 15%. Fixed income, however, faced more challenging conditions. As interest rates moved higher, bond prices generally declined. A reminder that bonds, like stocks, can experience periods of volatility. After a strong market rally, stocks are currently trading near the higher end of their historical valuation range at approximately 20 times earnings. Higher valuations often reflect investor confidence in future economic growth and corporate earnings. At the same time, elevated valuations can also leave markets more sensitive to disappointing economic news or slower than expected growth. Valuations are just one piece of the investment picture, but they're an important factor we continue to monitor. Economic growth has slowed somewhat in recent months. Current estimates suggest real GDP growth for the second quarter is around 1.2%, down from projections above 4% earlier this spring. One contributing factor has been higher energy prices. When consumers spend more at the gas pump, they generally have less disposable income available for other purchases, which can weigh on overall economic activity. Despite slower growth, most economists do not currently expect a recession over the next 12 months. As you can see on this slide, recession probabilities from several organizations generally range between about 15% and 30%. While risks certainly exist, the broader economic outlook continues to suggest modest expansion rather than contraction. One historical pattern we monitor is the presidential election cycle. Historically, the third year of a presidential term has often produced strong equity market returns, averaging approximately 17%. Of course, history doesn't repeat perfectly, but long-term market tendencies can provide useful context alongside current economic data. Several factors have historically contributed to stronger market performance during this part of the cycle. These have included pro-growth fiscal policy, increased government spending, tax legislation, and other economic stimulus measures. While every cycle is unique, these historical patterns are worth monitoring as part of our overall investment process. Historically, the fourth year of the presidential cycle has also been favorable for investors. In fact, since 1950, the 12 months following a midterm election have generally produced positive market returns. It's important to remember that past performance does not guarantee future results, but historical market trends can help provide perspective when evaluating long-term investment opportunities. One of the biggest risks to both the economy and financial markets remains inflation. Inflation has moderated from its highs, but it remains above the Federal Reserve's long-term target of approximately 2%. If inflation proves more persistent than expected, the Federal Reserve could decide to keep interest rates elevated or potentially increase rates further in an effort to slow price growth. One of the primary contributors to recent inflation has been higher energy prices. Gasoline prices rose sharply, although encouragingly, recent data suggest prices have been trending lower. If that trend continues, it could help reduce inflationary pressure in the months ahead. We also monitor market expectations for Federal Reserve policy very closely. Current market pricing suggests investors see some possibility of additional interest rate increases over the coming meetings. Of course, expectations can change quickly as new economic data becomes available, and we'll continue monitoring these developments carefully. Our second topic focuses on one of the biggest technological developments we've seen in decades: artificial intelligence. Throughout history, we've seen major technology platform shifts transform the economy. The internet reshaped how we access information. Smartphones changed how we communicate. Today, artificial intelligence appears to represent another significant technological evolution with the potential to reshape many industries. As AI models continue to improve, they have the potential to dramatically increase productivity across many professions. Many routine tasks that previously required human effort can now be completed much more efficiently, allowing people to focus on higher value work. Although we're still in the early stages, the pace of innovation has been remarkable. This chart illustrates just how quickly AI capabilities have improved. Tasks that only recently required several minutes of human work can now often be completed almost instantly, and the complexity of those tasks continues to increase. At the same time, adoption across industries remains relatively early. Many organizations are still evaluating how best to incorporate AI into their operations, suggesting there may still be considerable room for future growth. Our final topic is one that's much closer to home: portfolio management. One discipline that plays an important role in our investment process is portfolio rebalancing. Twice each year in May and November, we review portfolios and make adjustments designed to maintain each client's intended level of investment risk. Rebalancing can involve trimming positions that have grown beyond their target allocation while adding to areas that may have become underrepresented. Without periodic rebalancing, portfolios can gradually take on more risk than originally intended. In this example, a portfolio that began with a 60% stock allocation gradually drifted to over 70% equities after several years of strong market performance. While that may increase returns during rising markets, it also increases downside risk if markets become more volatile. Regular rebalancing keeps portfolios aligned with each client's long-term investment objectives and risk tolerance. You may wonder why we typically rebalance in May and November. Historically, markets have tended to perform more strongly between late fall and early spring, while returns have often been more modest during the summer months. Although seasonal trends are never guaranteed, they are one of the several factors we consider when determining the timing of our portfolio reviews. We're pleased with how our investment strategies have performed during the first half of the year. Our internally managed portfolios outperformed their respective benchmarks over this period, reflecting both our investment selections and asset allocation decisions. As always, past performance does not guarantee future results, and we remain focused on managing portfolios for long-term success rather than short-term outcomes. As we look ahead, the economy continues to present both opportunities and challenges. Inflation, interest rates, technological innovation, and market valuations will all remain important themes to watch. Rather than attempting to predict every market movement, our focus remains on maintaining diversified portfolios, managing risk thoughtfully, and making disciplined adjustments when appropriate. Thank you for your continued trust and confidence in Sentient Wealth Group. We appreciate the opportunity to serve as your financial advisor. If you'd like to discuss your portfolio, your financial goals, or today's presentation in more detail, please don't hesitate to contact our office. We'd be happy to schedule a conversation. Thank you for joining us.